didn't do it. So awesome. All right.
That
So
was top secret, right? I didn't see the agenda, so I had to go to Facebook and I saw the Facebook Live. I was like, I got all y'all.
awesome. So we're going to get started here because we've always got lots of things to share. Thank you very much again for joining us on our Wednesday webinar. We are having a great event this Saturday in Houston, Texas. It's building a capital raising business hackathon. You can scan the link. We'll also put a link in the chat in a minute that you can join. So this is a full day. We did 2 weeks ago, we did buying a multifamily in a day. This one is the capital raising business. And then we're going to be having the next one on asset management. And if you missed them, don't worry, we're doing a replay in Dallas in a little bit of time. But it was an amazing event. It really did go from 8 to 6. It was a long day. We had to get extra coffee brought in to keep me awake, but it was fantastic. We had 46 people in our room joining us, and it was super, super interactive. So don't miss out. This is something that we're really, really trying to do well. So that's the agenda of what we do. So you can see it is an action-packed day. We break everybody into working teams, then we do projects as a group, and then back into working teams. And it very much aligns with what Massive Capital does with our Massive Capital Mastermind, which is where we have an interactive way for our students, our partners, actually they're really partners, to be able to join us and become a part of what we do. So we're super excited. We hope that you can join us. So we have our other, it's now our fourth virtual conference, or third or fourth. It's fourth. Been so many of them, and it's coming up on May 10th. We will stick a link again in the chat in a second here. This one is Friday, May 10th. And again, it's an all day, but this one is virtual. So for those of you that aren't able to travel to our events here, and we go through a whole series of topics for everybody to learn. Again, there's a lot of networking. There's things that can happen. We certainly hope that you can join us on that event as well. All right, today we're on our Wednesday case study. And for those of you that got the email, it's a typo. So don't worry about that. So these are educational series. Our goal is to share what we believe is the best available information at the moment. So again, you got to make sure that you understand you still need to do your own research. You still need to study what to invest. You still need to study what you're going to do. But it's our goal to share all of the information that we believe to be currently accurate. So we're going to talk a little bit about Massive Capital, our value add to partners in investing. Today, the capital stack is to design it and pitfalls to avoid question and answers. And we always have a great quote. The way to make money is to buy when blood is running in the streets. And it actually has another one where it says, even if it's your own blood. And so, again, you want to be able to learn from what's happening, learn from different market conditions, learn from things that are happening. And that's our goal again today, is to try to give you a little bit more information to be able to learn. So Massive Capital is a vertically integrated real estate company specializing in ground up construction and retail, flex space, industrial, mixed use, multifamily. We're an owner operated for value add multifamily assets. On the map, you can see we're very Texas centric, but we do have assets in Colorado, North Carolina, Atlanta, Georgia, and we have been looking for retail developments, triple net in Phoenix and Tampa. We just haven't pulled the plug yet. We're involved in an equity fund, brokerage. Brokerage is on the triple net side, same with the property management, development, construction. We also have technology and our Massive Capital Mastermind. Our sister company, Realty One, has about $290 million in assets, very much in the retail and industrial and flex space. And then Massive Capital just cracked the $200 million mark. We have multifamily mostly, but we do have a project called X Space in Houston. By the way, for those of you that are partners with us on that deal, we got the building permit. It's first week of May, we're starting to go vertical. I cannot wait to see this. This one is going to be super, super, super cool. And then we have our new build retail opportunity that we're doing here in Austin. This is the team behind the team. So again, you'll go through and you'll be able to see all of the different things that you can do, all the people that you would connect with. Our team continues to grow. So it's super, super exciting to be part of this. It seems every day we've got a new person to add onto the list. This is the main partners. So we have Shirar, who's here with us tonight, Sanjay, who might be joining at some point, and then Mike is up taking care of some family things, and you wish him well. And then on the Realty One side, we have Bo, Pat, and Alexis. So again, we're super excited. Current activity, so in 23-22, we did 15 closings. We have some new construction finalizing a PSA for in Houston, Texas. We have offers pending in Dallas, San Antonio, and 3 in Houston. And we're just about closed out on our Horizon apartment. If you ever wanted to know what true value add, this is the indication. This is true value add. Okay, this is a very nice asset that is absolutely primed to be able to go to the next level. It just needs somebody to love it, to take it to the next level, to be able to put some of the things into it, add some sound business practices. We bought it at an amazing purchase price, just under $84,000 a door in a market that it's about $100,000 a door. We managed to do a loan assumption, 3.78. We managed to get a supplemental loan. And for those we're talking about debt, right now debt is tough. And when a lender gives you a supplemental loan based on your business plan, that is a big stamp of approval. And that particular loan still was at a higher interest rate, but our blended rate is a fixed debt at a blended rate of 4.46. Super amazing. It's a super exciting project. A couple of our partners and friends were there last week. We invited some of our students and potential students, and we were building pool furniture. If you can imagine, for 3 years, they've got 2 pools and they don't have pool furniture. Who wants to go to a pool with no pool furniture? I'm a lazy old guy. I want to sit there and watch my kids swim. And so just little things just to add those touches to make it a community where people feel like they've come home. Super, super important. So, all right, massive value add, group learning by actually doing. Okay, it's super important. A lot of people give you the theory, but we do more than that. So in new construction, you're a landowner and you are hoping to have somebody be able to come in and joint venture with you to develop a piece of property. We're your people. We're not looking for sand out in West Texas, swampland in Houston. We're looking for A-class locations where we can build retail, industrial sections, multi-use lifestyle centers. If you have a project that has a lot of work to it and you need some help on construction, we can help you there as well. Multifamily, we do asset management. We're going to be doing a series coming up soon about our proprietary system that we've developed, where we're very proactive on all of the assets that we have. It's very, very important for us to be able to do that. We can help out with credit, or sorry, CapEx, so renovations you need to do, or credit enhancement if you need someone to be able to help you with your balance sheet. And then we have our sponsor now, our Client Harbor, pardon me, and I'm going to stick a link in the chat. This is our new CRM system, and we have offered a 14-day free trial. So kind of like a no-risk peek under the hood. So I'm going to put that chat in there. Now we've launched our first poll, and the reason that we do these polls is it's super important for us to know who's here, and we really do look at this to see who's here and then plan our future topics. So we're always excited that we have a lot of new folks, but we want to get an idea of how we can help you on your financial journey. All right, get your seatbelts on. get ready. We're going to turn it over to Sharar. I'm going to post a few links in the chat. Please don't forget about the poll. I'll really like to be able to get some information. And we're going to talk about the capital stack.
Carlos, thank you. Really appreciate it. So thank everyone for joining. I know it's about 6 p.m. CST. A lot of us, we got kids and families, so we always appreciate you all joining us on Wednesday night this late of the day. Just before we go, just to kind of set the context, first couple of slides will be a lot of context. It's going to be a little bit heavy, and I will talk you guys through it the way we understand. And then we'll couple that with microcycle, and then we'll couple that with a live case study. If we have time, we'll do the case study. If we don't, then we'll park it for another day. So I'll try to balance it. So on that note, as we go, the videos will be published on YouTube. Please subscribe so you have those all those updates. And if you have any questions, just drop a note on the chat box, and then we'll come back and cover those questions as we go. Before I get started, I would say there's one very interesting thing that is happening for us, as you all know, that we love to do everything in front of everybody else. So not only we catch our mistakes, but also we get to share what happens underneath the hood, right? Because oftentimes watching the game from the sideline or from the stadium is different than playing the game within it, and we want to reduce the barrier to entry. On that note, we tend to see ourselves a little bit more academic team, and we are working closely with Rice University. So our third in-person conference that we're going to hold, and I believe we're going to host it at Rice campus in about 2 months out, next month. So get ready. And I think we're the first syndicating team who will be hosting a training seminar in terms of asset management and the software and the platform. We'll bring the corporate and the multifamily together and inside the Rice campus. We're really excited. So just wanted to kind of share a little bit more about what's coming up for Massive. All right, so let's get started. Now, some of you guys may know about it, some of you guys you don't, but I will assume that we'll just do a grounding and then walk you guys through pros and cons as you kind of go through. So typically, if you look at the capital stack, so capital stack is the whole thing, and including everything that we, will spend to buy, right? Let's assume we'll spend $20 million to buy a property. Then the whole entire 20 million, how do we do the construction? So on the left-hand side, you could see the senior debt, then the mezz debt, then the preferred debt, and you get the common equity. If you look at the left side, we go from bottoms up, which is the risk perspective. It's the senior debt has the least amount of risk. When the market is in a down cycle or things sort of doesn't work out, lender will pull back. They will say, hey, I used to give you 75%, now I'll give you 65%. So they will take the first and a lean position, but in return, they'll give you the most amount of money. Secondary is the mezz debt. Mezz is in between. So on the senior debt perspective, there are two kinds of debt, which is a recourse and non-recourse. Non-recourse, I still place my balance sheet, but if something were to happen, that risk contains with the project mostly, and less will come to us. In other words, they're not going to come to my house. On a recourse, something were to happen, then they'll go after the house and or everything that I have. Mezz, it's a blend. Some part of the debt could be recourse, some part of it non-recourse. It's a negotiating that you have to do with the local lenders, and then we have the preferred. They're mostly on the project side. Then we have the common equity. The goal and the objective of today's session is give you a definition a little bit more around each of those and how a team could design a project and on top of the operational value add, financial value add, and create value for everybody in the system. And what is the right time and a place for it to kind of use that. So the first thing, again, the senior debt have the lowest risk on the capital stack because secured by the property. And typically about 100% of the time, we'll see 100% of the properties that we transact in the real estate will have a mezz debt. And even what we call it, even all cash buyers should put a lien, a synthetic debt on a property, just in case something were to happen or a lawsuit were to happen. So theoretically, almost everybody should use a debt structure to buy almost every asset, even for single family. I know there's some house flippers out there, don't buy with the cash, but pay, put a lien, have your left hand borrow to the right hand, and then structure it that way. Mezz, it's a risk perspective, it's a little higher risk than a senior debt, as it is, it sits on the second. They're compensated by the increased risk and higher interest rate. One thing to remember, on the finance end of it, returns matter, but risk-adjusted returns matter more, right? Not all 17% made the same, right? And in real life, if I jump off of a 5-foot wall, if my reward is $10, if I do off of 50, then by design it should be $50 return, right? But our goal is to minimize the risk, maximize the return. So we call it alpha return, which is better risk-adjusted return. If Billy takes the same risk as massive team, and if Billy gets 10% return, then we should get 12% return. So that's how we take a look at the projects. And the deals that you see on the Mezz debt, there's typically new construction, retail dev, local credit unions and smaller banks will offer that. And the larger debt we don't see on the Mezz side. And or if you're a large developer, we have had one scenario with Realty One where you took enough loan and they want to give it to you, but they want a little bit more certainty on the return. So they will say, you know what, sign that note as a Mezz. So one side, if we keep your balance sheet almost clean, on the other side, you get more proceeds out of it. When not to use, when market is too volatile and you don't have a potential upside, then you shouldn't use the Mezz debt. This is your way, we call it debt overhang. This is a work your way up, that setting yourself up when the market turns really, really quick, then you get stuck with it. The other one is the pref and the risk. Again, the risk is it sits between a Mezz and a common, and this is the way it goes. Types of deals that we see pref checks are being used is mid to large multifamily deals, around $20 million ish. That's where the preferred structures start to making sense. I'll talk a little bit more about it, the pref structure. And then again, when to use pref, it's when you have a moderate upside. And the down cycle is a little bit on the, not in the horizon. And when not to use pref, it's when the market is volatility or you are on the top cycle of the market. And then pref is not to used. And most of the pref had some other nuances. We'll talk about it, and you'll see how that makes sense. And the last one, the common equity, the highest risk layer on the capital stack, and as the investors, the loss to be paid. And then 100% of the multifamily that we do, it's on the common equity. And now the question is, when do we take Mezz? When do we not take pref? What if we have Mezz 0, pref 0, and common sits on top of the senior debt? All of a sudden, my risk profile changes. The common equity takes a less of a risk, and it kind of go, right? So next couple of slides, we'll just talk through how that happens. So next slide that we'll talk about, which is the Mezz debt and pref debts are 0. Let's assume 0. We kind of take it out from the deck, and we create just one, which is the common equity. Then we'll split the common equity into 2 groups, right? So again, and then this one with the common on top.
Just to be sure everybody understands, people who passively invest in the syndications are in the common equity stack.
Equity. Thank you.
Yeah, just to be sure it's clear.
100%. And again, please let us know on the chat, and we'll go back and cover. The videos are available. We're going to go a little bit deep, then we'll come back out. Again, that's the beauty of what's behind the curtain, right? Behind the deck, what happens? Trevor, thank you. So let's look at the standard deck, right? So cap stack design. And again, we call it a design, right? There is no must. It's a design based on how we see the project would work. So in this particular case, it's a standard process, and most of the syndication happens this way. We have a debt and a partner, agency debt, or some kind of a debt. Then we have the class A or the common equity. All the LPs will sit into the common equity. So, and then we said, okay, let's separate that out and see how we can park the LPs right next to the lenders, and they take a little bit of a less risk, and then we'll add the return. So class A's are typically second position after lender, and then usually LPs will sit into this bucket. They may have a cash and the cash preferred or your cash flow position out there. Class B are the third position after class A. Usually GPs will sit in this bucket. Class B's may have the controlling power. Class A's will not. So class A will get benefit with the lower risk and the cash flow preferred position. Class B sits behind the class A, but they have the controlling power, right? That's one way to design it. And sometimes you'll see some of the projects where class A, not to bring the certainty or to show the strength of the project, class A could behave like a preferred equity. That means whenever cash flow happens, The first cash goes to senior debt, which is the lender. Second tranches of cash goes to the Class A. Then the remaining goes to the, your Class B. Now, that's where the fourth one comes in. Sometime within a Class A, we'll have two separate or three separate, depending on how a sponsor will design it. I call it Class AA and a Class AB. The difference is they are the same risk profile, but the return goes up and down a little bit depending on how much capital someone brings in. If someone brings in $100,000, hypothetically, they'll get 7% return, 19 IRR, or an investor brings in $500,000, which is 5 times more than we could say, you know what? When the 100,000 investor gets 7, thank you for trusting on this deal. We'll give you 2% more from the GP side. So instead of 19 IRR, for most of the investors, you get 21 IRR, right? Because think about it, it's a trade. When you accumulate and bring a large stack of capital, it helps the projects and it helps the investment hypothesis. And then from the Class B will bring out some equity into Class A and give it to the larger investor, and to make sure that we support the investors and they get a little bit extra return. So going back, Class AA and Class B, between those, they're mostly the same risk profile, but the cash distribution and return profile, depending on the investment type, it is there. Massive side, we tend not to do it unless it's a big chunk. We like to keep things simple. So for us, it's a 70-30 on a non-recourse deals, 50-50 on a recourse deal because of the risk that we mentioned. And then, most of the time we'll have a 7 pref in there. So we support risk-adjusted return. So it's a lender and the Class A, and then us, and the waterfall gets distributed the same way as well. Now, second one, this one I want to make it a little bit more interesting. So we have Class A and a Class B. Now we changed the definition. We injected a Class A, then we have the common equity Class B. So in other way, this Class A got moved up to B and B moved up to C. And this is when in between lender, and then we brought in a preferred equity. Now the question is, what are the differences, right? So again, Class A is the second position, right? Usually the LPs, sorry about the typos. And then Class B is the third one, usually GPs and pref checks. Just wanted to talk a little bit about the pref cash flow. Whenever we talk about pref equity, there are two kinds of pref class on the marketplace. Number 4 is the hard pref and a soft pref. So when you as an LP take a look at it and you hear there's a pref component to it, you ask the question, what kind of a pref, soft or hard, right? Hard pref means after we pay the lender, 100% of the cash flow will go to Class A first. Class B and C doesn't get anything by design till they hit their expected rate of return, whatever that could be. Soft prefs are the gentle one. They say, you know what, even though I sit in the middle and before the common equity and after the lender, I'm comfortable to share the cash flow. I get something, after that you get something. I don't have to get 100%. I'll take maybe 60% of the deal of the cash first, then. So that's why it's like a happy family type things, right? So typically smaller check writers, $2 to $3 million, they tend to be the hard pref guys. And the fund, fund has a high velocity return type, that's the hard pref. On a short duration type projects, we'll talk hard pref, but mostly we don't. We work on the soft pref, and you'll see soft pref is the most of the time that we can work on. Now, then the question becomes, look, if I'm an LP, I got the lender, in between me and lender, we have the Class A's, the pref equity, what's my benefit, right? Why do I take the additional risk and seeing on the third one? So the benefit is almost all the preferred equity that you have, they have a cap. At the LPs, when you talk about we split 70-30, whatever the profit is, 100% of the profit gets 70-30. When a pref guys comes in, they don't split 100% of everything. They have a cap. Sometime, so I will example number 7 on the larger checks, they look for 15 IRR and that's it. They don't get paid anything after 15 IRR. Everything goes to the common equity. And then if on a smaller 17 to 19 IRR. So what happens if there is a project overall return 18%, then pref takes 15%, then we have an extra 3% bonus that goes to the LPs. All of a sudden, LPs are supposed to get on the class the common equity is supposed to get about 18, 17%. But since you're picking up the leftover from pref, you get about 3% to 2% more. So whole idea is that if we bring in pref, or whenever we bring in pref, LPs must get a higher rate of return, or the spread has to happen. And that's the benefit of it. Again, risk adjusted return, right? They get lower risk, hence they should get a lower return. Common equity should take a little bit more higher risk, and they should get a higher return. So when you look at on the LP side, when you go back in, if you do evaluation of a deal that has a pref, you ask the question, what is the pref it's going to get? Then you ask the question, what is the difference between a class A and a class B spread? If the spread is the same, then extra risk, no return. Why would you do that? And if the return is more, then it makes a lot of sense, right? Because if the lender gets paid same as the pref, then why they will bring the money, right? So that's the whole idea, that whenever we bring the pref check in, whole idea is that even though the project margin is the same, or the value of the project is the same that we can create, then what happens is, pref takes a little bit smaller, so remaining gets bigger for everybody else. So we can synthetically create a higher rate of return by giving somebody less, which is the pref, and pass on the rest of the profit to everybody else. So what I will do now, I'll put everything together, right? Pull all three charts together. On the left side, we talked about this, primary debt, mezz, pref, and equity. In the middle, that scenario we talked about, where you take out the mezz and take out the pref, just look at the A and B, right? LPs and GPs standard. On the right side, you bring back the pref, and then you have the class B and a class C, and as you can see, what happens. So how we look at it, every single project that we do, we have two components of value adds. One is the operational value add, which you mostly know, and which is the number 2 items on the slide, which is the rent growth, vacancy, capex, opex, and lastly, speed of execution. There's not much beyond the operational value add. And one thing I didn't mention is the market given. So when market gives, it's a bonus. So a bonus is not an operational value add that we can pro forma it out. And a lot of the community made the same mistake on the market side. So take the market out. On the deal side, operational value add is the standard. Everybody takes a look at it. And those are the about roughly 4 or 5 levers that you have. But then we ask the question, the financial value add. Remember, the common equity is the most expensive equity, right? And we call it cost of capital. So a project has a cost of capital to create a certain amount of margin of the profitability of the project. Then we look at the cost of capital and we design it such a way so that allows the maximum benefit to the project. Okay, so what we say, look, do we go raise $10 million and by design we have to give 20% return, or we need to give 20% return to get the $10 million investments, but the project's overall return, it doesn't allow to do 20%. But for the same project, if we bring in $10 million at a 20% and bring another 10 million at a 15%, then my overall project return doesn't have to be 20 anymore, it has to be 18. So it's a balancing act. And also we do those now, especially because of a couple of reasons that I will kind of talk about. So again, oftentimes you'll see some of the folks will say, oh, I'm not going to do pref because it has some other trigger to it that I have to follow certain guidelines. I have to make sure I perform a certain way. And if I fail to perform, then somebody else come in and fire me, right? For us, look, it's LPs are hiring us and the sponsor team to execute a project. By design, it's a contract. We have a performance to deliver, and we are going to deliver, right? Just like any other job. If you fall behind, what do? You sit down, have a professional conversation, then you take over the project or let the person go. So for us, we look at that way very objectively, where, hey, if you can add value with the financial design, and we can create the boundary line for the pref equity checks, where we have enough operational, breadth into the project, enough performance breadth into the project, and we can create value for everybody. Why not do that and right size the project, right? So that's the philosophy that we have. All right. Now the question is when to use pref, when not to use pref, or when to use all common equity, when not to use common equity, and vice versa, right? So we have a slide that we used before. It's that as sponsoring team, as investor, what we call it, we may not know what that cycle will look like moving forward, but we should have a generic idea or sound understanding where we at in terms of a cycle, right? And so this is a typical cycle that we go through. We have the maximum and points of maximum financial risk, and then points of maximum financial opportunity. One of the note that we did, Bloods down the street, we underwrote 240 properties in the last 3 months alone. I'm comfortable to say 70-80% were upside down deals. And that's because they have financially designed certain things on the top of the financial market, right? 21, 22 is right here. So 21, 22 was right there, 23 probably was right there, and 24 was around here, right? And on the right side is the risk profile. Now we talked about it. Take a look at the right box here. X-axis is risk, Y is return. And the debt structure tells you what kind of a risk that you take. When the market is on the top cycle, we should not use pref check, we should not use bridge debt academically, and then we should use fixed and Fannie and everything else, right? So our McCollum property, we bought it and in the thick of it, it's less than 4% fixed for 7 years. Market could go up and down, but 7 years we have enough breathing room. We're moving. And most of our portfolio, almost all of our portfolio, no, except all but 3 out of the 15 are fixed debt, at least for 2.5 years. So when we did the debt, we did it that way. It was different, it was difficult, it was tough, but we did it because of that version of it, and it's paying dividend for us. And 2 of the other projects, timing wise, we are working it through. So the point is, when the market is in a cycle, you don't put yourself against the market, right? You want to be on the side of it. So what happens? This is what we do. So we believe we're at the bottom of the cycle, and it's not going to get any worse from where we are. Some movement, and it's going to stay longer for higher. So our position is we're higher for longer interest rate. The rate cut maybe 2, if that, this year. Some maybe next year, but we are here to stay. So it's not rates not swinging the whole lot to make or break any deal. So on that note, this is the time you leverage up. So get as much of a debt as you can. Still is cheaper, highly levered up, and you get into a deal, because even though the returns could be same, if not a little bit less, your assumption going into the deal are much more solid, much more stronger, and we're extremely closer to the market, right? So again, have this in your mind and have this chart, risk profile, and the timing of the market profile. Like if you ask Massive, we don't know what the market would look like. At least you have our assumption is that we are the bottom of the market, and the bottom will continue for a little bit before it goes up. Hence, we should do this design as you go. That's also a reason since almost a year and a half now, we're bullish on bridge debt. And up until now, after the McCollum, we do not underwrite any loan assumption less than 4.5%, which is don't. We want to stay close to the market. We did the Horizon because even though loan assumption was less than 4, the supplemental was more, over 7. So putting together blended was almost 5. We liked it because we are staying close to the market, right? If I pay 5% today, then when I have to sell, if it is less than 5%, we automatically in the profit. On top of that, you add a value add, so we'll get more margin, right? So we could do financial value add, and we can also do operational value add, right? So you stack it together and you do it. So from Massive side, yes, anything less than 4.5%, and loan assumption, we don't even underwrite. Less than 4, we don't take a look at it unless there's a supplemental. On the flip side, we love bridge debts. We love loan assumption with the blended rate closer to 5. We love deals that are upside down where I can do a loan assumption where I have a high leverage. That's because of this philosophy.
Hey, sure. I think it's super important right now to talk a little bit about a lot of the deals that are in trouble are because of bridge debt, but because of where we are in the market, bridge debt now is the answer. And of course, that's all dependent on the change in interest rate. But I think it would be a really good point because, we talked earlier in some of our other webinars about what happened, right? People got 3% debt and now all of a sudden their cap rates have expired and they're in huge trouble. And now we're So 3 months ago, we said bad, it was bad, but now we're saying it's good. But I think it would be really good to understand why that delta and what's driven that delta. Because it is significant.
So think about debt payment and the timing of it and your value creation, right? So for us, multifamily, it's always been the revenue game. It has never been the cost game. If somebody buys a multifamily, unless it's a broken down 100% OPEX ratio, those are outliers, but usually multifamilies, if your investment hypothesis is the cost efficiency, and that's the only way you're going to create value, good luck. It's a royal pain that you're about to have. But we need to see a very good way to increase the revenue. So the revenue is the play for the game, and within the revenue is the market growth and the value add growth. That means I have an older unit, I can fix it up, make it nice, and and that has a spread. And the second one is market is moving as we go. So on the top of the cycle, we forgot that market has a risk. Before 2022, for past 4 or 5 years, as investors, we got used to the fact that just because I bought the property, I made money. And I could stop my chest and say, hey, I got 40% return, 50% return, but I forgot that's a gift, right? Not the true value add. So when that happens, your revenue becomes very skinny. And then on the OPEX side, you have non-controllable, right? We took a look at it, how much of the OPEX, which is the operating expense, we can control and how much we can't. If we think about Texas, about 50% of the money, we have no control over it. Government comes in, or the city says that's your tax, boom. Large companies come in, AIG says that's your insurance, we're out of money, right? So 50-55% of the expenses that we have in Texas, we have no control over it. And then when that uncontrollable went up too fast and you could not increase the rent and your time was too short, you got crossfired into different ways. That's exactly what happened most of the times here. That assumption that they made when they bought the property for the market growth, that went to zero to negative. And then the insurance and tax went up too fast, too quick. So the total cash flow needed to refi the property to take the money out, that was not there. So when the time came to refi, I'm out of time. And that's where everything is falling apart. And then on top of that, if you have a small syndicating team and just putting it through barely, then what happens? They're out of money as well. After first time, yeah, you can shell out 100, 200, 300 grand, but then everybody has a limit, right? Then you taper it off. And so putting all together, most of the deal that we're seeing is that. Now, last webinar, we talked about the wave, the debt wave. Most of the sellers that upside down last year, they said, you know what, we got into the vibe of this year, it's going to go down, and everything will change, we'll sell. So we pushed it back, we held back the sale from last year to this year. And then lenders also in the same boat, because what they're going to do with the property, because the market price is shot. Doesn't matter how many hands that they change. So they got a little smarter too, and they're open about it. They are also saying negotiate. So a lot of negotiating happening with the lender, a lot of negotiating, and a lot of kick the can down the road, and I'll see you in 2025 and 6. That is happening. So all in all, most of the issues are boiled down to 4 things. Your market revenue you did not get, then your uncontrollable, which is tax and insurance, went up too fast, and you took a 3 years bridge or 2 years bridge and you're done. So what we call it is, look, multifamily is fantastic. It's awesome value to be created, a huge margin if you do it right, but you got to understand a little bit more fundamentals. You got to be able to take a position, defend a little bit, build the investment hypothesis, and do not follow the crowd all the time. So that's then how I take a look at it. So yes, I've seen good operators, extremely good operators are having a tough time because some of the assumption they could not throttle down fast enough. And I have seen, I flipped 2 houses, all of a sudden I want to go buy a 100-unit apartment. I don't even know how to read a balance sheet and stuff. That's a whole polarizing view of it. But all in all, I get to say, one of the good thing about that though, everybody is fighting. I'm yet to see anybody, doesn't matter how weak of a team they are not fighting, right? So it's amazing to see how the sponsor teams are looking at, talking to each other. and trying to figure out a way to protect investor money, so that, hey, you know, it's, yes, we all took a hit, but then if we can park away, help each other's out, and protect investor money whatever way is possible before I give the key back, that has been the mantra for the whole community, and it has been just amazing. We work with a lot of sponsor team. We have a small sponsor team group that we work and share ideas to make sure that, hey, if someone can help, need some help, or we can trade some deals, we do that all the time. Trevor, good point. Oh, on that note, please, polls. And I will talk about it, how data is important. Please take about 10 seconds to the poll, and that reframes us on what topic to bring out and how deep we go, and versus where we stop, right? So thank you. And I'll support Trevor, right? We all love Trevor. So 25% is too small. Let's push it to about 60%, Trevor. All right. So I'm going to do evaluation. Again, please drop a note on the chat. I'll go through quick on the valuation and see what would that look like, right? Okay, so let me bring it up. So let me give you the background of the deal first. Some of you guys may know the deal. So this is a property. We took a look at it about 3-4 months ago. Look at the top left side of it. FYI, accounts being paid. So don't. I bet you money I got a text on it. So this is a property that we take a look at it. So when we underwrite it, we come take a look and underwrite via the software that gives us a view of what the T12 looks like. So the takeaway from here, if you start with the vacancy, the seller have stabilized the property already. Their physical vacancy, it's around low single digits, and their economic, it's about 12 to 13, which is very healthy in San Antonio, right? So operational value add perspective, going in when we're going to make an offer, you kind of sort of know not much there, because San Antonio as a market is not going to have a huge growth this year, maybe end of next year on the market side. So we really have to see on the property side, can I add value? And this one, going in, it's a pretty healthy project, right? And again, no one should underwrite anything above 150 units or so with 8%, 9% economics, right? It's always double digits, low double digits. It's everywhere. Even though the broker can tell you it's 110% physically occupied, economically there's much less than that, right? So, and then cash flow, it's pretty steady in 6 markets. So if you take a look at it, the average is pretty steady. So seller has done a good job. They capped out, right? For almost a year, from April 23rd to January 24th, they held it steady. So they have done a good job, which is operational value add. It has been eroded out from this project. So that's the takeaway, right? So we did this, we looked at some OpEx ratio and a bunch of other stuff. So we said, okay, it's a good project. We like the location. We love the setup. We walked the property, and the management team is one of the coolest team I've seen. So, okay, that makes sense. So let's look at underwriting as you go. All right. So I'll walk you through real quick. Again, this is gonna be quick, but I just want to show you how pref we look at it to do this. It's a $43 million deal, and we said, and hypothetically we said 39.5, and it's a $10 million raise. And that's there right here. I'm looking at it. I'll highlight it as I go. It's a $10 million raise. In today's market, raising $10 million, it's quite a bit of work, right? And then based on that price out there, it's about 16% return. 16% return on a class B minus asset in today's market is too low, unless you have some forecast to do. Now, and at the project level, let's look at the project level. At project level, 18%. 18% is too low at the project level. It's just too low at today's market, because rate is 5.5, 6, bridge is around 9, profits are 15 or 17. Why would you take so much risk for 5 years for that much money, right? So that's the first pass. At the first pass, it didn't pass, right? Because 18%. Now let's take a look at it. So what we do, we design the pref, we look for the spread, adjust for the risk adjusted spread, and we adjust the offer price. So what we said is that as a base case, if I have to raise $11 million at a 16%, my overall profit has to be about $19 million. Right? Someone brings in one check, $11 million. After 5 years, we have to give you back almost double, right? $19 million. And now I'll design it. Design with the pref, design with the LP. So let the pref guys bring one check, $5 million, and LP is 18%, right? What happens is here, 13% check get you 8.5, 18% get you 11.5. Put together, if I can bring in a lower equity partner, I still get the same, right? So in a sense, I can get away paying investors 18.5% if I can bring in a pref partner at a 13%. So we fork out that 3% from the 5 million, bring it back to the 6 million. All of a sudden, it start making sense. So first pass, 16% for LPs. It's not, I wouldn't do it today unless it's a class A. But at 18, 19% makes a lot of sense, right? So the financially, this project makes sense, right? We said we can do it. And then we asked the question, the flip. What if something happens, we cannot deliver, or we're going to go through a little oops and ups to get to that, right? What happens? And then we asked the question, what happens at that point in time? And because the project is pretty healthy, as we talked about it, there is not much of a value add needed. So do I have some breathing room? And when we went to the analysis of it, we decided we need some breathing room, and we need to have, and we also found out the pref is not 13, they went up to 15. For pref to be 15, I gotta pay around 17 to the LPs at the offer price. It doesn't work for us. So first, when the broker came up, we looked at it, we said, no, even though you asked for $42 million, I know how you get there. At a 39.5, it doesn't even make sense unless you go down to a $38 million. Right? Then it makes a lot of sense. At a 38.5, it makes a lot of sense. And that's how we looked at this project. We made an offer at 38 first. We stopped at a 39, and then seller wanted to strike the court at 41, a little over 40. We said no. Every $1 million puts a pressure on it. I'm not going to take an extra risk. That's because you have done a good job already. I don't have much to do, right? We add value by doing work, and I don't have breathing room to do work. So all in all, we didn't end up doing the project. Now it was a lot. So it was a lot. So I'll stop, right? With the last thing I would like to share with everybody. Look, market is tough. But this chart that I saw last week before last was amazing. Invest with a little bit more longer view. Multifamily is not house flipping that I can buy and flip the freaking house in about 6 months and I make money. It takes years to do it. On the larger assets, 5 years. Anything above 200 units, take 5 years. Less than 200 units, it's about 3 years. Less than 100 units, you can flip it in 2 years, right? So, but have a long-term view, come in and do invest, even though you have invested, some of the projects probably didn't work out, but do invest. Because if you stop, you don't get the money back at all. It's absolute loss. But if you continue to invest, you'll aggregate it out. So our position has been invest all the time, even it's scary, invest in a smaller amount and build your portfolio as you go, and build your portfolio with a little bit more longer view. And today's deal, it is much more and much better assumptions, really in a solid foundation even a year and a half ago. So with that, I'll stop. And then I'll open up for questions. And again, thank you for everybody. It was a lot. So hopefully you had a flavor of how we take a look at it on the underwriting and a pref. You got the theory, you got the theoretical view and the real-time example as well. Okay, Trevor, back to you, buddy.
Awesome.
Okay, we got a question from Nancy.
Nancy, go ahead.
Go ahead. Oh,
Hi.
There she is.
hey.
She's the one we had to call with this morning, and she joined our thing tonight already. Thank you.
Yeah, it was a lot of information. I don't know if it was me, my equipment, but I couldn't really hear you. So I'm gonna have to do this again when you do it again. So how do you do your underwriting, and is that available? How you do is it a plug and play for your underwriting?
So the Excel file that we use is called Synthesis. You can buy it online. We can link it here. The software that we use is called RedIQ. It's a licensed software. You have to buy the license subscription. It's a pretty hefty one, but we do it. Everybody in our mastermind, they get it. They get the software as a part of the exercise. So yes, we can give you a link with the software, with the Excel file. You can have it. You can plug and play it. And what I would like you to think about it is understanding Excel is not same as really working the Excel file. because a
Mhm.
model, almost all of us will get the model, right? Plug in a cell A, you get the result in the cell B, right? But
Mhm.
really, it's interesting part that you have to think about it is what number we are typing in and why we believe the number is the right.
Okay.
It's not 1 and 1 is 2. It's why it's
Right.
1. Why it's
Right.
not
Right.
0.8. 1 is 1.2, right? So yeah, that's the
Right.
model.
And what value do you put on on that number that everybody wants to get to, 10 and 11? What value that I personally, this is my personal opinion, I think that that is an arbitrary number. I think that is a number that anybody could plug and put whatever in there. What, what emphasis you place on that?
Got it. So to us, everybody says like, we like to define like we're engineers. And so we call it, everything has a definition. When someone says, it's my belief, but define your belief and also build the confidence level on your belief. Like, why do you believe that? Just because you feel
Well,
like it or you saw it, then you kind of test it?
no,
Then,
my belief is I can pretty much create whatever that number I want for myself. So going in saying I gotta have a 10% or 11%, I think it's ridiculous and it's crazy. Again, me, because I feel that if I am able to cover my debt, cover my expenses, blah blah blah, and make what I want to make, I don't care what that number is.
which is true. And let's push a little bit more. You don't care, but market is semi-efficient.
Mhm.
Where I'm trying to compete with you and I'm willing to pay a little bit extra because I want to do a deal, right? What happens? A logical Nancy get bypassed with illogical Charlotte. And so our request is stay logical and continue doing that and get grounded with as much data as you can and then
Mhm.
play off of the data. That could be your arbitrage that you have.
Okay.
So I'll share a little bit more. So this is our dashboard and we track everything. If you could, we'll track our heartbeats too, right? We on the road about almost 1,000 assets in the last year and a half. We have collected all the data. We have that data in a data warehouse. So if I need a data point in Houston, in Dallas, in Austin, I just go to our database and we take a look at it last 10 times, how many properties we on the road and how many financials we have, right? That's how we take a look at it.
Okay.
Good question. Thank you.
Okay. I just wanted, because I know a lot of people place a lot of emphasis on it, and I just wanted to know if it's me or if it's like really, just an arbitrary number. And so you were saying and I heard this at the end, and I don't know if I missed something in between, was if you stop investing, you lose your money. I didn't understand that.
So what I meant to say, let's say I invested in a property 2 years ago, $100,000, right?
Uh-huh.
And for whatever reason, the project took a 20% haircut. I got back $80,000, and I lost that $20,000, right? And if I do not invest anymore ever in my life, that $20,000 is gone. But if I take that 80, reinvest again, and I get back 150, I'm still in the money. The whole point is you have to continuously invest and invest and
Oh, you mean
invest.
reinvest in the same project?
Not same project, maybe a different project.
Oh, okay. Oh, I got what you're saying. Oh, I thought you were saying like if you
No.
stop, it's like if you put, I'm like, wait a minute, what?
No.
If you put 100,000 in, right? And you're in. You're gonna get back what you get back from that. You don't have to put anything else in unless something happened, somebody
Right.
went away, and then you want to make sure the project is completed, then you may be ready to add to it, right? My
That's right.
question is, when you refinance your projects, do you return the investment and still keep the investors in, or when you return the investment, they are done, they're out, they're gone?
It will depend on how the project is being set up. For our projects, our investors' ownership do not change, even though they get the money back.
All right.
So the return gets better because I don't have the burden for the capital anymore. But if you come into a deal, hypothetically, you have 10% ownership. After refi, you still have 10% ownership.
Right, even though you got the money back, and then when it's sold
Exactly.
way later in the future, you get that 10% then again.
That's cool. That's how we design it.
Okay.
Now, could it be a spot where, the whole design of the project is to take the investors out? Could be, but we haven't done it yet. So we like to keep all the investors the way they come in. At
Right.
some time, project could be there. So there's no right or wrong as long as you're okay with it.
Okay, and last question, I'm not trying to hold up all the questions. Last question is, how open are you for someone is bringing a project to you for you to fund and or manage or however?
Good question. Thank you. So for us, what we say, we build teams in between the deals. So we got to get to know who that person is, what the long-term view is, what their specialties are, and we're going to role play, we'll practice, we'll simulate, and then we'll do a deal. It takes about, for us, 3-ish months to build a relationship with anyone so that we can do a
Okay,
deal. We don't do a deal right away just because.
right,
It's a lot more get to know you, a lot more practice, a lot more testing out, and simulate the environment that what's going to happen once you do a deal now, and then we go do the deal.
all right, truly last question, how do we do this simulation?
So we have 2 clients, right? One is every day we underwrite deals. All of our massive mastermind partners, we are running the deals. So you can join from the outside and webinars, and we can run some emails, go through. But if you want to work with us, close by with us almost day to day with our whole team, then we would like you to be inside the mastermind. That way we underwrite the process, you have our tools, and we are running at a different speed. So you get to be part of the whole thing.
Okay. All right, thank you.
Good question. Thank you.
Thanks.
All right,
Awesome. There was a question on the underwriting calculator. So we use that one as an off-the-shelf one, Synthesis, that you could buy. And then and then Red IQ is a more expensive program that is available to our mastermind students.
So
But
we
you gotta
do Red
remember,
IQ.
all of those are a tool. Without local knowledge, without a team to bounce the things off, there's more, right? Otherwise, you're just plugging in the blind numbers. I'm gonna get a 10% rent bump. Well, how do you know that? How do you do the rent comps? What are the true rent comps? I'm gonna do this, I'm gonna do that. Without some area knowledge, and that's why our collecting of all the information from every market we look at is super, super powerful. Any other questions? We really appreciate everybody joining. I know tonight was a little data heavy. But it's super important to understand when you're investing in a deal, how is the capital stack? Where are you in the capital stack? And are the assumptions that the sponsors made realistic in the capital stack, right? So if you're fourth in line and they're telling you, I'm giving you a 10 prep on your money, you're going to get it at the end, because there's kind of the cash has been squeezed. That you just need to understand that when you're investing, it's very important. And part of the reason why Massive keeps it fairly simple is to make it a little easier to understand. All right, we're going to shut the recording off in a minute, which means you can ask us anything. And all these, remember, get put back up on our YouTube channel.
Yeah. The recording off yet?